Well, with us now is Dan Niles, founder and portfolio manager at Niles Investment Management. Dan, it's great to have you on the show. Welcome.
Thank you.
We'll start right there. What do you think of this?
Well, you have to separate it into pieces. So if you're asking, what do I think about the stocks of the AI companies? I think they're going to go up a lot for one simple reason. The Fed's cutting rates after being on hold for 9 months. You're going to get another probably 3 cuts between now and January. And then you're probably going to get Stephen Myron being the new head of the Federal Reserve in May, and he wants rates about 1.5% lower than everybody else. So in an environment of easy money, you're going to be able to fund a lot of cash burning businesses and have everybody be treated like everyone's going to win. So from a stock perspective, that's how I'm thinking about it. Now, if you want to look out several years from now, or maybe at the end of 2026 when rate cuts are done, and you go, all right, are people going to get more discerning about these circular investments? And are you going to figure out, well, which AI companies are actually going to win versus the ones that are going to be sort of left behind? Then I think you're going to start to see some problems. But in the near term, I think these stocks go up for one simple reason. Easy money funds a lot of cash burning AI businesses.
I just got to take a little divergence here because you just mentioned Steve Myron as the possible next Fed chair. Why do you think that? I think just today he batted down rumors that he was even considering it or in conversations about it.
Well, I mean, let me put it this way. There's a reason he's out. If you look at the Fed dot plots, he wanted 125 more basis points of cuts between now and the end of the year. So that would mean 1 cut of 75, 1 cut of 50. President Trump, as we all know, gets to appoint the new Fed chair. And as last I saw, Myron was still part of the White House administration while he's on the Fed at the same time, which has not happened in a very long time, right? Usually you resign your prior post. So we'll see how this works out. But I think it's pretty clear that the Fed, much like in 2021, where I thought they should have been raising rates, they convinced themselves inflation was transitory. They kept rates on hold, and the S&P finished the year up 27%. And so I think right now, the Fed wants to cut regardless of what inflation being above target for 4 years, and the White House wants rates down. Whoever gets appointed, let's say it's not Myron, it's somebody else. It's going to be somebody that wants to really cut rates a lot. So easy money drives everything up. And that includes stocks, Bitcoin, gold, wine, art, you name it, just like it did in 2021. And that's what's going to happen again. And in that environment, every company is treated like a winner because every company can get capital.
If I go back to AI here, is it still AI infrastructure stocks where you should be putting your money to work here right now, especially as I would argue quite a few CEOs in corporate America are saying both publicly and privately that at least for now, at this moment in time, the rhetoric and the reality in terms of the capabilities of AI are diverging?
Oh, they completely are diverging. But again, that's 2 separate questions, right? Because if you think about it, you go, okay, you've invested between the 5 biggest spenders out there. So Google, Amazon, Microsoft, the 3 hyperscalers, you throw in Meta and Oracle. Over the past 3 calendar years, including this one, you will have spent $800 billion from just those 5 guys in CapEx. The industry at total will be about $1.2 trillion. OpenAI this year is expected to produce $13 billion in revenues. The entire AI native, so companies that don't have other businesses like Microsoft, Google, Amazon, et cetera, just the AI native companies like OpenAI, Anthropic, Perplexity, et cetera, in total are going to generate about $20 billion in revenues this year, with $13 billion out of OpenAI. That's against $800 billion in investments. So at a certain point, yes, you're investing all of this, but somebody has to be willing to pay for all of this infrastructure. And in the near term, nobody cares because stocks are going up, right? So everybody's going to win. But are you going to get a massive shakeout at some point when the easy money stops, I think the answer is absolutely yes. At this point, my brain is on thinking that this is kind of like 98, 99, where, you know, you have easy money through whoever the next Fed chair is. Could markets be up 20% this year and up even more next year to start? Sure. And then could you have much more discernment and then a massive meltdown after that? Sure. But in the near term, you want to stay positive because, you know, you go back to the late 90s, right? 1998, NASDAQ was up 40%. 1999, NASDAQ was up 86%. And then the first part of 2000, the first 2 months and change, it was up, you know, 24% to start. And then, of course, we know what happened. But it was a 6-year build, you know, to get to that, 6-year build to get to that point from when you had the introduction of the first mass internet browser, Netscape Navigator, at the end of 94.
Okay.
So you got to that peak in 2000.